Welcome to the Property Partners Podcast, where we break down the steps to build real wealth through smart property investment. I'm Ross Lacane, buyer's agent, property strategist, and former top mortgage broker, here to share insights from decades in the game, alongside some of Australia's leading experts. Welcome to episode 4 of the Property Partners Podcast. I'm Ross Lacane. Again, I've got my co-host, Munzrul Khan. Welcome, Munzrul.
Thank you very much. Thank you, Ross. Look forward to it.
Mate, I've never seen you so on the edge of your seat excited, because today's your topic, right? We're talking about tax. What other sometimes puts some people to sleep. You get excited about it, and I'm excited because I can feel your energy and excitement coming off this such an important topic. And it's when it comes to property investment, and a lot of people, and I think I've seen studies before, one of the things that motivates people to get into property investment is quite often, I'm paying too much tax, right? And again, yes, it's a driver. It's a reason why they think about it. It shouldn't be the overall goal, though, should it?
No. I mean, 100%, Ross. I mean, we always sort of say that tax, you almost see that as a bit of a bonus, right? I mean, whether it's a byproduct, it's a bit of bonus. But you don't do the investment purely because of tax reasons. Many reasons why you don't, and many reasons why that thinking is a falsified economy. Yeah. And why is it? Is because you only get a tax refund when you pay tax in the first place. And the whole mindset is, I suppose, is that how do I move into a retirement goal? And the natural assumption in that retirement stage is that you're not working, right? So you're not paying the tax, so there is no tax selling here. Point one. Second point is that tax is a portion of what you paid in the first place, right? So I spend $100, it's tax deductible, I'm getting $32 back. But the question is, do I need to spend that $100 in the first place? Because if I didn't need to spend that $100, if I were not to spend that $100, you know what? Rather than getting a $32 back, I would be saving $68. Yeah. And 68 is better than 32. Right? Yeah. So it's not so much the tax. And then what it does is, like, if you just purely rely on the tax, then you start investing, and arguably perhaps not the right level of investments, right? Because sometimes I see property investors sort of say that, well, we want to buy properties into brand new properties. Nothing wrong with brand new. If that is what is right to you, that is what is right to you. But not to invest in a brand new property simply because it gives you the depreciation. Take that depreciation as a support, as a byproduct, but not for the investment because of depreciation or tax benefit. Does that investment still make sense? From all the fundamental side of it? Is it growth oriented? Is it cash flow managed? Is it risk managed? Is it your quantum over a period of time? Does that make sense? If it does make sense, tax only comes in as a product. All right. Now we're going to start, and I'm going to ask a question that a lot of, when I've been a mortgage broker and as a buyer's agent, the word negative gearing gets thrown around. But when you ask a client to explain what their understanding of it is, not too many people can articulate it in a very simple way. So I want you to dumb it down and give your most basic explanation of negative gearing for the audience. So negative gearing, Ross, all it means is that when your income from an investment or property is lower than your expenses on that investment of the property. And that's what the negative gearing is. Yeah. So it's gearing, but it's gearing in a negative way because my expenses are higher than the income. Right? Yeah. And then what that negative gearing does, it gives you a tax benefit. Yeah. So let's say, as an example, that someone is earning about $150,000 salary. Yeah. And you've got a property where your rental income and your takeaway agent's commission, council, water rates, all the rest of the expenses you pay. Rental income is a bit higher. Let's say it's about 27 grand. By the time you take away all of those different expenses, and so you come back to 22 grand as an example. That's your net rent. Yeah. And let's say on the other side is that you borrowed a certain amount to purchase that property, and your interest cost happens to be say 32,000. So you've got a 32,000 as your expense, 22,000 as your net income. So you are negative by 10,000, which is 10,000 is your negative gearing.
Yes.
Now, on that example, that someone is sort of earning, let's assume 200,000, or they're not 50, right? If someone earning 200,000, that 10 grand as a negative gearing goes as a deduction against your taxable income. So rather than now earning 200,000, from a tax point of view, you earn 200 minus that 10,000, which is 190. And what that means is that because you already paid tax on that 200,000, assuming you earn 200,000, on your salaries and wages, you get a tax benefit out of that 10 grand because you already paid tax on it, but you didn't need to because it was a negative gearing.
Yeah.
And on that example, the tax benefit is 4,700.
Yeah.
So that's the negative gearing, and that's the tax benefit.
So very simply, the property net income was 22, your costs were 32, it's negative by $10,000 and it can come off your taxable income, right? So, and then I guess in reverse to that, it's, and again, reading someone, you might have the audience out there that have just stumbled upon Rich Dad, Poor Dad that's been around forever and a day. And, they talk about positive cash flow and positive gearing. And again, in this day and age, in this market, very hard to find something that would be positive geared, especially in this interest rate environment. But because it is a term that's bandied around and written up in books, you want to just, again, explain positive gearing in
Positive gearing, it can happen, and we'll go in a moment how it happens, right? But effectively, all positive gearing means it's the reverse of the negative gearing, where your net rental income is higher than your interest. So if you go through the same example that my rental income is 27, I pay council water rate, insurance, and some repairs and maintenance agents fee, I go down to 22. But this time, I'm sort of assuming that the borrowing is much lower. And because my borrowing is much lower, my interest is much lower. And rather than having a $32,000 interest, is that I'm going to assume that I've got half of that borrowing of what I initially had. So if I have half of that borrowing, my interest is only 16 as opposed to 32. But my net rental is still 22. But now my 22 is higher than 16. So I've got a 6,000 of positive gearing. Now, with the same philosophy, how that 6,000 of positive gearing works is that the 200,000, which are the salaries and wages, now 6,000 will be added as opposed to being subtracted. So now you get a 206,000 as your taxable income. And that 6,000, you never paid tax. So now you've got to pay tax on it. And the tax on that 6,000 will be at 47%. That's the positive gearing.
And so what examples, and you mentioned you've seen a couple of examples of positive gearing. What examples do you see where the clients of yours may be in a positively geared situation?
We very often, we sort of do the maths saying that we should do the maths with 105% of the purchase, right? So someone sort of, let's say buying a property of 800,000 and you look back into the tax and he's only borrowed 80% against it. That's what the bank allows. So, but the question comes in, where is that 20% coming in? And where is that 5% incidental coming in as well as stamp duty, solicitor's costs, right? So that 25% can be coming in from your principal place of residence, as an example, where we borrowed 25% against the principal place of residence, use that as an equity to buy the rest of it. Now, in that example, it'd be very hard to be positive cash flow because you really are 105%. So with the exception, I suppose, is that if you genuinely have cash that you start with, that I'm genuinely borrowing 60% or 70%, it can become positive cash. Commercial properties get much closer to the positive cash flow, but if you take away 105% loan, it still seems to be struggling, but it gets much closer, right? Then you sort of look through into the superannuation side of it, and you sort of say, well, the superannuation, because you can borrow maximum 80%. There's some real exception where you can go 90, but because you can borrow maximum 80%, means that you genuinely truly have 80% of the interest cost. So if the returns are high enough, so you've got a house with a granny flat, which keeps you 7.5%, 8% return, And then on the other side, you've got 80% of the leverage, even if your interest rate, let's say 7%, 7% interest, let's assume, and then you only borrow 80% of it because you cannot borrow more than 80%. You're genuinely using cash. 80% of 7% is 5.6. But on that example, house with a granny flat is 7.5, let's say, as a gross. So you may be slightly positive. So when we add away all of those, we can see these are all exception. Where real exception, where the true positive cash flow comes in, not so much immediately, with time. So if I look back my very first property which I bought, in day one when I bought, it was slightly negative cash flow. Right? But now I look back and I said that I bought this particular property for 120 back in 1999. Rent was about 170 at that stage. And I look into the same property at the moment, which is sitting about 650 or so as a rent. And then if I say 650, my mortgage is being paid off. But let's assume the mortgage is 120. And I've got $650 as a rent, which is like about 33 grand or something as a rent against 120 grand. So if I divide 33 with 120, I get like 25, 27% gross yield.
Wow.
Now, that's positive cash flow. But the reason why it's positive cash flow, because of the time it takes. So all time, over a period of time, makes the negative gearing positive gearing, because the cash flow increases, rent continuously increase, and we assume that the interest rate more or less stays within a boundaries.
Beautiful. All right, so staying on the topic, and that's been great because we've demystified what negative gearing and positive gearing. What do you think from a tax perspective is the next biggest consideration, when property investors are coming to you in terms of what's the next biggest sort of tax implication that people need to consider?
A risk mitigation that we must do and must do it in the right way is the deductibility of the interest. And the reason I say that is that the interest is the one which gets very messy. What property investors very often do, and I'm generalizing, don't you're buying it first time, you're buying it for a certain amount, you sort of paid it off, a little bit of it, and a little bit of it, and a little bit of it. You still got a bit of loan, but you've got a whole bunch of equity because you paid a bit, the asset value has increased. We buy our first investment property, we buy our second investment property. What do we do with the first investment property? Very often we take the equity from the principal place of residence to buy the first investment property. Then when we go to the second property, we may again use the principal place of residence. We may use a mixture of the principal place as well as the first investment property as a deposit to buy second. When we go into our seventh and eighth, we're using a little bit of there, a little bit of there, a little bit of there, add that away, that becomes our deposit, right? Where the commissioner gets a little bit upset is to say, I as an investor, you as an investor, you need to track down each one of those loans, that what was the purpose of the loan. So let's assume that one of the transactions I've just taken to have taken 100 grand. Out of that 100 grand, I've sort of said, 70 grand I'll use to purchase, 30 grand I'll buy a car. I need a new car, so I'll buy a car. But the car is for personal needs. That 30 grand is not deductible. So getting the interest deductibility in the fully substantiated way, in an audit-proof way, is an absolutely fundamental to get it right. Second point, I suppose, is the amazing how we still miss out on the depreciation. We spoke about the depreciation that had cost $500, $700, $800, but you get a schedule which almost lasts forever. And the benefits, you get it so many times over 25 years. It just makes sense not to give away that depreciation if it applies.
And a good point on the depreciation, because, they changed the rules a few years ago, and so working out whether your property has depreciation attached to it can be quite confusing, right? So is there any sort of tips that you can give to say, when is your property likely to be depreciable?
The more the newer the property, better it is, right? More the renovation of the work is being done, better it is. But the best way of knowing these things is that run this through with a quantity surveyor. Very often what the quantity surveyors do, and so good that they do this, very often what they do is that they take you the description of the properties, they do their analytics, ask you a couple of questions. When did you buy? What did you buy? What are the renovation that you've done, and so forth. Then they have their own bit of the database. They give you an estimated cost. They sort of say, okay, this particular property, you may get about $6,000 the deduction every year. Or they may come back and say, you're only going to get $300 deduction every year. Then you can do the maths very easily, right? So if I'm paying $700, $800, I only get a $300 deduction. I get about 40% of $300. I only get $120. It would take me 5-7 years to get my original amount back. May not be optimal.
Okay.
But if you say that, well, I'm getting about $6,000 back in the first year, right? So that not only covers it, it double covers it in day one. It is absolutely worthwhile. So what I suggest is that with all my property investors client, when you buy it, run that through with the quantity surveyors. Take a bit of feedback. Is it worthwhile? And the good quantity surveyors very often come in and say, it's not worthwhile of doing the depreciation. Or they come in and say, it is, and here is the cost.
Yeah. And on your first point, I agree, right? That can be messy, especially, from a loan structuring.
Yeah.
I know in my mortgage broking days, we don't want to cross-collateralize properties because it adds all sorts of complications, and that's probably a podcast for another time. But in terms of what are some record-keeping tips to be able to, that the investors are listening to the show can put into place to ensure the ease of that? What are some of the best practice?
Good question. The first thing is to take into in principle the onus and the responsibility is on each individual investor. Australian tax system is a self-assessment system. What we present to the government saying that this is my tax, prima facie government accepted, subject to review and the audit, then they can do it any point of time. If they do the audit, then you have to prove that substantiation. So it always to keep that as that audit proof. That's the first one. How do you keep track of it? Is that you keep track of every single transaction. My principal place of residence, I bought it for $1,800,000. I borrowed, I paid 200,000 many years ago. Makeup example, right? And that 800,000 that I brought it down to say 500,000. And then when I'm buying my investment property, I went up there and borrowed another 300 against it, which I paid. But this time, this 300,000 is that what I borrowed used it for buying the investment property. You need to have a clear audit trail saying that here is a proof that I increased it by 300,000. Yeah. Here is a proof that that 300,000 purely went in terms of buying this next property. That bit of the clear audit trail needs to be there. Secondly, in terms of the data keeping side of it, what one of us ATO's bug is that not to have the data being polluted. ATO sort of finds it very difficult is that when you sort of say, take that 300,000, that could be a separate line, and you decided, all right, I'm going to take 40 odd grand for the car, I'm going to do this, I'm going to do this. And you know what, I've got left of 210 grand, I'm going to use about 190 as a deposit, I'm going to leave this 20 odd grand, and you know what, I'm going to put my rent into it, but at times I'm going to just take some funding out of it for personal reason. This is what ATO says, it is all cumbersome. So you need to have a very clean audit trail. I borrowed 300. Use that 300,000. Here's that 300,000 to use that as a deposit to buy the next investment. Absolutely clear audit trail. In an ideal world, your Excel worksheet that you do, you must run that through with the accountant every year as part of the return. Is that sufficient for us to prove?
Beautiful, beautiful. And I'm sure you could give some examples and templates for, people that that come and use your services. All right. So we've spoken about, some key factors, right, in terms of interest deductibility and proof. What else? And again, it might be more like structure or buying entities, or what other implications from a tax point of view are key when sort of purchasing investment?
It's very important, Ross. The structure is very important for a whole bunch of reasons. So if you buy it into the wrong structure, your land tax will be much higher. If you buy into the wrong structure, your tax benefit will be much less.
So when we're talking structure in this case, we're talking whether we buy it in an individual name, whether we buy it in a joint name, whether we buy it in a trust structure or a company or a self-managed super fund. This is what we're talking about, just to clarify.
Yeah, no, absolutely. That's exactly what we're referring now, in that which name do we buy? Say one of the previous centers said as an example that you raised it, right? That if you buy it on a joint tenancy or tenancy in common, buying it together as such, you get one land tax threshold in New South Wales as opposed to two, and it could have a massive impact. So say as an example that if mum and dad bought few properties and they've got an asset value of $2 million sort of a land value, land tax is, on that example, is always on the Governor General's valuation of the unimproved value of the land. So that's a conservative value, but nonetheless it's a land value. So let's assume that it's a $2 million is a land value, right? Now, if those $2 million asset portfolio, if it were bought on a joint name between mum and dad, 50% each, 70-30, however way it is, they would be paying land tax for about $1 million in there, which is at 0.16%, is $16,000. Not once, every year for the rest of your life. But all they have to do is to buy some on her name and some on his name, and then he would have two thresholds, and he would never pay that damn $16,000 for the rest of the life. Right? Massive impact. And see, very often is that when people go ahead and people buy it, right? Once you bought, it is so difficult to unwind. There's an incredible amount of cost involved. So what we say to all of our clients, give us a call before you buy any property. It's probably the most common discussion I have. Mansur, I'm just about to buy this particular property. Do I buy on his name, her name? Do I buy it on trust? Do I buy it in company? Do I buy it on self-managed super fund? What is the right structure? Each has got positive and negative, and we go through and deeper with the client before we give the advice work.
Exactly. And not only is it around land tax, it's around, what income, how is that going to affect, we've spoken about negative gearing and so forth. How is that going to affect the negative gearing? Because, sometimes we can take a joint loan and the property is 100% in one person's name, right? So in the case of the land tax, but just because it's a joint loan doesn't mean the interest gets split, does it? Right?
It's a good question. Good question. And the answer is no, because your deductibility of the good question. Your deductibility of the interest always goes back to the underlying ownership. So the loan could be on a joint name, but if the property is purely on your name, I can only claim it on your name. And say equally so many other criteria, right? When someone buys a property, asked us the question whose name we buy, we always sort of say, let's make a decision with a balance in our mind, because there's always positive, negative on both sides. Tell me about the ingredient of the properties, right? And the client goes through the ingredient, and I sort of say, so it's quite negative cash flow, this one. Here's control. I'm buying it on negative cash flow because over a period of time, this will happen, that will happen, growth will happen, and sell it. So I sort of say, well, if you're negative gearing, you probably arguably would like to buy it on a higher income earner. But at the same time, if you're planning to sell it in 2 or 3 years, you as the highest income earner also needs to pay the tax, so take that into account. If you sort of say, no, I'm going to build a granny flat, I'm going to subdivide, it would become quite positive cash flow. Then we sort of say, arguably buy it on the lower income earner. Then we sort of say, okay, hang on, let's have a look through how many properties you have in New South Wales, how much of the land tax threshold you've utilized. So the gentleman may have already utilized the land tax threshold, the lady may not have. So we said maybe buying it on the lady's name. Once you've got 4, 5, 6 properties, then we sort of say, would trust be an option? If there is a commercial property being bought, we sort of say, would trust be an option? When there is a self-managed super fund, we say, would a self-managed super fund be an option? All of those has got a positive and negative, and the trick behind it is that must run through your accountant in advance before you do this. And see, you as a buyer's agent, that even we work very, very well, right? Because a particular property, when you sort of find, is that we already have that discussion within ourselves. And that's what that communication, that's what that team play comes in, right? That we have that discussion.
Oh, exactly. And I think, you touched on a couple of different entities there. And now let's have a look at sort of, the pros and cons. Like, let's break down, right? So if we break down, because a lot of information and there's some influencers are talking about trusts and should buy in a trust and you should do this and that. Let's talk about the positives and negatives of the different entities. So do you want to sort of just talk through that a little bit?
Yeah, and it's such a big topic, right? But at a high level, is that individual is simpler. And individual means that you get the negative gearing on your own hand. Individual means your land tax threshold is quite a bit higher. So those are positive. Negative is that you don't have any asset protection if things goes wrong, Right? I had a property at a point of time that the young kids, they were playing around, teenager kids, and one of the young girls, she fell off from second floor. And I've heard from the court, Mr. County being asked into the court because of your negligence or for whatever your property, you don't have the, verandas being high enough. And the teenager fell off. And I was like, it's an old property. I don't go around and check it. When I bought the property where the big veranda is high enough, but there was building reports that have been responsibility. No, Mr. County, you are the one who owns it. At the end, this particular property, it went all the way to the federal court, and it was being found that I was okay by a few millimeters. What happens if I were not okay by a few millimeters, right? And I'm sorry that this young lady, she fell off and she broke her arm and sort of broke her leg, and she was drinking, right? But broke her arm and leg. But it comes back to us, to me as an individual. That's a simpler example. It could be many other things can go wrong, which could be a concept called thought of negligence. Thought of negligence means that I've done a negligence without knowing it. But unfortunately, in the law and in the eyes of the law, that ignorance is not an excuse. The court says you should have known. I understand you don't know it, but that's not an excuse, right? You should have known. So thought of negligence, we fall into it. Individual, we do. If we go to a trust gives you that protection. Trust sort of gives you that protection where you don't really own it, you control it. So they can still go after the properties of the trust, so to speak. But anything which you own on your individual name, arguably they're a lot more protected. Whereas if something goes wrong on individual name, they can go after every other property that you have on an individual. So it gives you that protection, right? Trust also gives you the tax planning, right? So you made a significant property, you can distribute that, some of those profit distribution in sort of the way that you wish to. And you can distribute to mom and dad, kids, grandkids, and parents, and sort of in-laws, right? And brother, sister, nephew, niece, assuming they're under the age of 18 and they're Australian resident. So it's a lot more flexible. So you get the asset protection and you get the tax planning on a trust. We'll come back to the leverage in a moment and the borrowing, whether there is a benefit. The negative of a trust is that there is a setup cost. Negative of a trust is that there is a running cost. Negative of a trust is that you pay land tax from $1 in New South Wales. Queensland, you've got a threshold lower amount. Victoria, you've got a threshold even lower amount, right? So these are some positive and negative. If we go into a company, negative of a company, you don't get a 50% CGT discount. You pay tax as such. Positive is you get the asset protection. If you go to a self-managed super fund, the negative is it's quite a bit of cost to set it up. It takes a bit of time. You need to get a financial planner involved to do a SOA. And based on SOA, you may or may not be eligible to establish the super fund. Even if you do it, it takes 3-4 months to establish, takes a bit of cost. But the positive is that with a super fund is that you can leverage. So you can effectively borrow up to 4 times, if your serviceability is right, up to 4 times of your initial capital. So you can buy long ego asset raised with the super fund. Tax rate is 15%, capital gain tax is 10%. You got the best of the asset protection. So there are some positive with the super fund. Of course it is, with a couple of negatives attached to it, right? You add away all of those and you sort of say, okay, I know, Mansoor, you've given us a gibberish for about 5 minutes. What does that mean? Means that there is no one solution which is right for an individual. Discuss that with your accountant side of it, of your individual circumstances, and where do you fit in within all of those positive and negative.
And I know for my situation, the way that worked, and, we bought a number of properties within our personal name to take advantage of the things like the land tax thresholds, right? To take advantage of the negative gearing benefits that were on our individual names. And, we then diversified into different states and did similar things with the land tax thresholds and so forth, right? And then it came a point in time where, it was logical to create a family trust. And so we went and did that, Now we're at that time where, we've just established our self-managed super fund, and now, our next purchases will be through the self-managed super fund. So it's an evolution, right? It's an evolution, and this is how having a great accountant helps you with that evolution because it gives you that other set of eyes. It gives you that strategy. It gives you that ability to effectively plan. And, whilst for me in my portfolio, it's not about tax minimization, but it's about the growth, and the growth of investments has been phenomenal, but also the level of tax that I have paid over the years. And again, I joke about you getting excited about tax, but I can almost hear it in your voice when we have those conversations, when you call me at the end and you tell me how you've been able to sort of manage it and the end result. And, it's phenomenal. So it's amazing, what difference a great accountant makes when you look at sort of my experience, right? So, what more have you got to add as sort of, let's wrap this up in terms of, we've spoken a lot about the different, tax considerations. What else?
I think it's not just about tax saving. It's about absolutely staying within that rule of the tax, right? What is being allowed, what's not being allowed. And so then doing it with the assumption that Commissioner can review at any point of time. Commissioner makes it very clear. Tax minimization is okay. Tax avoidance is not okay, right? So how do we minimize the tax within the rules, within the regulation, and having all the level of substantiation is there? Nothing to do it ever out of line, nothing to do anything crazy as such, but at the same time, everything which is being allowed is that how do we do this? And equally, probably the last comment that I'll say is that the work of the tax accountant, it doesn't need to be just individual as such. Ideally, the tax accountant works with the buyer's agents, works with the mortgage broker. We all work together as a team side of it, right? So when you're buying this particular property, we have that debate in terms of whether we buy it on his name or on her name. One is on the basis of the immediate tax. Second is the subsequent tax. Finance comes into account as such. The strategy of that particular property comes into account as such as well. So 2 points in here. One is that team environment, and second is the strategical decision without doing anything silly on the eyes of it.
Exactly. And, as a mortgage broker and as a buyer's agent, you see some self-employed, clients will run a tax minimization sort of strategy, right? And, but when we look at it from a property perspective and we see, all right, they're running a tax minimization, yes, it's saving them a little bit of tax, right? But when you look at, and again, with our last podcast was on risk and reward, and this probably falls into that bucket, if I can buy an extra $1 million or $2 million property, that may be $70,000 to $140,000 compounding each and every year, right? If I've got my numbers right from a wealth creation side of things rather than a tax minimization. So, having a good accountant that sort of understands property investment and not just tax and how to minimize tax. Is such an advantage.
Thank you. And then that's where the strategic service that we try to provide all of us together in one team, which is the KHI, right? So if someone joining on that KHI as a client, you've got this area of services. We never sell any services. If someone already has a good mortgage broker, we say stay with a good mortgage broker, right? If someone has a good accountant, we say stay with a good accountant. But just someone coming in and saying that, okay, so you guys do accounting, financial planning, bookkeeping, mortgage broking, buyer's agency, law, all those different services you do, it makes it easier from a client's perspective. From our point of view, it also makes it easier of providing a holistic advice, which is that entire team. So even if you don't use it, let's say the mortgage broking side of it, because of my knowledge on the mortgage broking, learning from the mortgage broker, I can provide enough tips to the other mortgage broker that they utilize to make sure that we are all in the right track.
Exactly. It's just a little question here or there that comes, and I know when we work together and as that team and we sit down with the mortgage broker, yourself and myself, the strategy that we can come up for the client, because the experience, that combined level of experience is sort of second to none, right? So
very blessed.
Exactly. Well, let's close, this has been, amazing. I think in summary, we've spoken about, the benefits of, you're negatively geared, how positively gearing work. We've spoken about the different structures and, the pros and cons around each. And, we've spoken about some other important things like the importance of record keeping and the importance of, how you actually manage your overall sort of finances to help you in that wealth creation space. So it's been great. Thanks, Munzrel.
Thank you very much. Look forward to all.
This has been another episode of the Property Partners podcast. If you'd like to engage with us, please follow and like our podcast. Your likes will go a long way. So give us a 5-star rating. Follow this podcast on your favorite podcast platform. We also have a Facebook group that we'd love to interact with you. It's the Property Partners on Facebook. Look us up and find us. And Munzrel, we also have a website. Do you want to give the details of our website?
Thank you. khrpartners.com.au.
All right. Excellent. Until next time, I'm Ross Lacane, and I'll see you soon.